Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today I wanted to take a quick look at Waste Management. This is a company that I've owned in the past, and I had heard someone mention it the other day, so I wanted to check in, see how the company was doing, see if it's worth investing in, and what the future outlook is. It's currently trading right around $200, right about at its high for the last 52 weeks, and it's been as low as 148. That 148 is much more in line with our fair value. We're looking at a fair value close to 153, which means we really would like to get the stock around 130, and we'd want to reevaluate around 169. So right now is about the time we'd be reevaluating. Discounted cash flows is actually coming up with 206. So cash flows are looking pretty good for this company. Earnings yield 4.05. They do trade at a pretty big premium. It looks like about a 33 PE on average, almost always in the 30s. To get the 5 that we're really looking for, they would need to come in with earnings close to $10 per share, and analysts are expecting 683 this year, 751 next year. Cash flow yield, about 9% last year on average over our time frame, which since 2020, they've been looking at 11% cash flow yield. That 11% is much better, so they've got potential. Looks like they saw a pretty big drop here over the course of the last 2 years, which essentially flattens things out for the last 3. Dividend, they do pay a dividend around 1.5% yielding right now. On average, it's about 1.6, so nothing massive. The payout ratio is about at 50%, so it's a pretty safe dividend. Don't expect them to be cutting that anytime soon. ROE 33.38% looks very high, especially when you look at the ROI and ROA, both around the 6 to 7% mark. So we need to look at the debt, and clearly the debt is high with a 4.08 debt to equity. Definitely something to watch out here. Just like a lot of the other blue chip stocks that we've looked at, the established companies, dividend payers tend to be high on this debt. Margins, gross margin, higher than average this last year, a low 38%, and net margin, again, higher this last year, 11.28 compared to the traditional 10.65%. Revenue growth, there was double-digit growth over the last 3 years. Slowing down more recently, analysts are projecting around 6% going forward, so we're going to put 6% for our thesis. Earnings per share growth, again, double-digit growth, slowing down more recently. Analysts are projecting it to go back to double-digit levels, though, so we'll see how that all plays out. Cash flows, like I said earlier, down in the last 2 years, up 1% in the last 3, so pretty flat there. Share count, they keep buying back shares. Last 3 years, 1.71% on average. So it's slowed down a little bit, probably just with the higher price of the stock. But we can assume somewhere in the low ones to be what they're going to buy back if they continue as they have. Assets, they're growing around 4% a year. Liabilities, they're growing around 5.75 or so. Dividends, they're growing 7 to 8%. And then margins, if they continue to grow it very slowly, we can put the 1% for our thesis. And all of this would fetch you growth in the fair value of the stock of about 8% a year, which isn't bad. That's essentially on par with the market. So it definitely would not be a bad hold. At today's prices, though, you're not getting a very good deal. You're looking at losing money over the course of the next 3 years based on the fair value. It'd come out in 3 years at 177.56 for the share price. And if you're buying in at 199, obviously that's higher. You might collect some dividends along the way, but you're still losing about 6%. In the next 5 years, assuming this thesis is true, you'd be looking at 14% gains, getting the share price up to 210. It's not a very fast mover. It looks like it moves $5 to $10 a year in fair value, and now does not look like a very good time. If you were able to get in at the lows of this year, the 148, right around that fair value, you'd be looking at returns on par with the market over the next 3 years, and then outperformance by 6% in the next 5 years. And that's what we're looking at for the stock here. Seems to be pretty stable. Just continues doing what they do, waste management. And when we look at all of the metrics graphed out, balance sheet is definitely dragging everything down. In fact, it looks like it's been on a decline over our time frame. The liabilities have been outpacing the assets in growth. Cash flows holding pretty stable. Saw a bit of a peak in 2021, flattened right back out. If they continue with the declines that they've been seeing in 2025, they will be lower than they were in 2019. Fair value of the stock just continues to trend upwards, helped a lot by the earnings, which are outperforming everything, and the dividend as well. This is clearly an earnings and dividend stock. I don't think the market cares a whole lot about that balance sheet or the cash flows. The cash flows don't seem too bad, though, if it's coming up with a discounted cash flow value of $206. Taking everything into account, that balance sheet really takes away from that cash flow that the business generates, and you have to discount it at least a bit. I'll put it on a watch list. I think if it gets down to 150 again, maybe even 160, I wouldn't mind. Let's see. If we put in 160, yeah, 150 is about the lowest that I'd really be willing to go. You get essentially on par with the market in growth over the next 3 years, and then over the next 5 years, you're getting a bit of outperformance. Now, if there's anything that could change here, I'd like to see them stop growing their liabilities as much. That right there would help them. I mean, not a huge boost to the average returns, but it is better. If I take this from 6 to 6.1% growth in revenue, you get another 0.07%. I feel like cash flows, they can definitely turn those around easier than anything else. But that doesn't have a massive effect on the stock. If we take it from -7 to 1%, it didn't really change the average returns much. You'd be needing to look at double digits at least to help that average return. That's all for this one. So I want to thank you guys for watching. Like if you enjoyed the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.